Hey, how you doing? Emmett Dempsey, Treasure Coast Mortgage. Today's video is about the 2022 mortgage and interest rate prediction that I believe is going to happen for our market here in Florida. Now, if you go back and look at this video here, 2021, I'm going to admit it was a pretty bad miss.
Just a bit outside. He tried the corner and missed.
I thought just based on what I was feeling coming off of 2020, going into 2021, we certainly had some interest rate rises. But today's interest rate forecast is based off of MBS Highway, Barry Habib. He's been one of the prescient folks out there who's really saw the tea leaves about where interest rates are going, and I'm just going to use his analysis because that's what I believe. Coming into 2021, I really believe rates were going to go down because I guess I didn't really believe that the administration was going to be as bad as it was and to let inflation run rampant as it has. But I guess I was wrong, so I didn't think they'd be that bad. I had high hopes, but they really dashed them. Also, if you guys would take the time to go ahead and subscribe to the channel if you haven't already, as well as go ahead and leave a like on this video. It helps the YouTube algorithm find more videos like me to help more folks like you. Also, go ahead and leave a comment. What do you guys think is going to happen with interest rates as well as the housing market? I'd love to hear your opinions. Well, all that out of the way, let's go ahead and take a look, and let's go take a look at the analysis. Here we go. Okay, here we go. Here's the market forecast. Let's go and take a look at the 2021 recap as far as what they were saying here. Okay, interest rates, they were expected to rise at the beginning of the year and recover into the fall. I had said that they were going to continue to fall throughout the year. Of course, I was not correct on that assumption. Okay, actually what did happen is rates did rise sharply through March, as anticipated, but it recovered a bit earlier in the summertime. And we had some good rates, last year as well. We had some good pockets from the clients, getting back most of their losses by late summer. Okay. Housing, the forecast was strong demand and tight supply, push home prices by high single-digit percentage. What happened was there's very tight supply and demand, COVID supply chain disruptions, what have you, and I think the case chiller was double digits. I know here in Florida, it's still double digits. I mean, supply and demand ultimately is still running the train here, and we're gonna see that happen until supply and demand starts to equalize. That's what happened. Okay, the 2022 dynamics as we're going into this year, this is what's going on. Tapering. Basically, what the Fed is doing is they're buying mortgage-backed securities, effectively keeping interest rates low. And what the tapering means is that it's going to go ahead and slow those down and taper instead of just stop. They're just going to stop buying as many mortgage bonds, and it's going to slowly try and raise those interest rates and off the balance sheet. And it can impact the equity markets, drive interest rates, impact housing as well as jobs based on what the Federal Reserve ends up doing. Okay, some Fed voting members rotate out each year. The 2022 composition would be a lot less accommodative as 2021. And fighting inflation is the main focus. Now, ultimately, you gotta understand, the Fed really cares more about the stock market because that's where a lot of Americans have their 401ks. So they're not going to do anything very quickly, and sometimes that works against them, and that's what's happening with inflation right now. Because in my opinion, and a lot of the Fed should have started hiking rates last year. Because the only way you can really fight inflation, and if you haven't checked it out, I think the last inflation reading was over 7%. It's the highest in 40 years. And the Fed needs to do something about inflation, and they've already said they're going to start raising rates in 2022. They should have already started raising those interest rates already. Okay, because they mistakenly thought inflation was transitory. That's a word we need to pay attention to. Okay, all right. So history can tell us, forecast how the Fed's action or inaction, so to speak, in 2022. Excuse me. It's going to influence the markets. So this is what we can expect based on history and other Fed presidents in the past. And let's go ahead and back in our time machine, shall we? Okay, this guy, Arthur Burns. It's a nice 70s style suit there. He was a Fed chair in the 1970s. He ignored inflation. It was rising rapidly. Insisted inflation would be transitory. How does that sound familiar? Okay, year-over-year inflation ballooned from 7% in 78 to 14% when he left in 1980, and hope to Jesus that does not happen right now. Okay, so Burns remained steadfast. Inflation was transient. It's to the very end. Higher inflation caused mortgage rates to rise from 12 to 18%, and in the 70s, it was known as high interest rates. And I always tell the story whenever I watch Rocky 2, when Adrian goes and tells Rocky, "Hey, we can get this house at 10%," and he's all excited about it, it's just crazy that where we've come with interest rates, from then to now. But anyway, so that's what Arthur Burns did in the 1970s. Rates were in the 18%. Okay, so in comes Reagan, in comes Paul Volcker. Okay, so change of administration. Basically, what he did to fight inflation, you hiked the federal funds rate. That's really one of the main tools the Fed has, is they have to hike that federal funds rate. Okay, he hiked it from 11% to 20% in 2 years. I mean, it was a pretty violent raise. So what happened? Inflation dropped. It killed inflation, but there's also some side effects. Because inflation dropped, mortgage rates dropped. They declined from 18 to 12. I mean, 18 to 12 in your mind, it's not that much, but 6 percentage points, 600 basis points, that's a lot. But there were consequences. S&P sharply declined 30% during this time. So what gets most headlines? The stock market. The bonds and inflation. It's like, okay, great, but this is what's going to need to happen. A tighter monetary policy, forced the U.S. into recession in 1982. So, but ultimately, this is what had to happen in order to fight inflation. Okay, and then we had another similar environment. Alan Greenspan, a lot of folks remember this guy. Late 1990s, inflation doubled from 1.75 to 3.5. I mean, that's not huge. I mean, it's still less than what's going on now, but that's what happened back then. Higher inflation caused mortgage rates to rise from 7 to 8.5. That's about, and still not huge, but still enough. And Greenspan, he didn't play. He's like, I'm taking action now. He took action. He hiked it from, by 1.75%. He just matched inflation, from 4.75 to 6.5 in a year. Okay. Inflation responded and it got back down to 1%. And we've been there, running around there ever since until recently. Mortgage rates dropped from 8.5 to 5.5. Sparked a huge refi boom. And I know I started in 2007. Where rates were still pretty high. But there were consequences too. S&P 500 fell by 50%. Again, you don't want to do this. It causes some really bad reactions to the stock market. They don't like when the Fed raises those rates. So fell from 50% from the spring to the fall of 2000. A lot of that too was .com. I don't know if that was all direct, correlation, causation. But the U.S. entered a recession usually because of the .com crash as well. But ultimately, monetary policy did have a factor in it. Today, under Jerome Powell, the 2021 inflation increased from 1.75% to 7%. That's where we're at, guys. I mean, it rose pretty quickly, and he's insisting it's transitory. Higher inflation caused mortgage rates, from 2.5 to 3 3/8. Today they're about 3.5. This is actually when this presentation was done. We've had some high inflation. Your Fed is currently tapering their purchases. So you have the taper going on, bonds and treasuries. They're not going to hike and raise rates at the same time. So they're going to shut down the taper and start to raise rates. They'll be done tapering in March of 2022. And they'll likely begin hiking in May. Fed targeting 3 rate hikes in 2022, 2 or 3 more in 2023, and who knows if more is needed if these inflation numbers keep on coming in like they're coming in. And if Fed can tame inflation, mortgage rates should drop. So my advice to clients these days is take the higher rate with no points. You have to be careful when you're getting quoted interest rates. These days there's probably a lot of points built into it. It's usually not worth it to pay. So make sure you shop around and talk to me about that. Okay, all right. So let's go ahead and see if we can see a pattern here. Okay, you have Burns and Volcker here. Inflation from 7 to 14, where rates were. Federal funds rate, inflation response, mortgage rate response, and the consequences. Okay, so that's what happened then. Then Alan Greenspan, kind of similar. Where rates were, the federal funds rate, inflation response, mortgage rates drop, and then but again, stock market. Okay, and here we are. So all this is setting up. Federal funds rate again from 0 to 1%. We're still at, guys, we're at 0. So raising rates from 0 it's still going to be historically low, especially to where all these other numbers were. So you have to keep that in mind. Inflation response, it should drop. It should drop inflation. It should decline, and then it should cause a reduction in interest rates, but it's also going to hurt stocks. So let's go and take a look at it further. Okay. Of course, there's some wild cards in this too, because whatever variant they come up with these days for that other thing, you can have a major surprise in COVID, can change outlook dramatically, any kind of stimulus, depending on also the midterms. We're in an election year, a lot of those different things. Additional stimulus may fan the flames of inflation, because it's going to push stock market. It's a boost to stock market initially, and it could cause rates to rise further, and it could just be feeding the beast of inflation. So, I know that the most recent stimulus plan was not voted on or didn't pass, so that's actually a good thing. You're not causing more money printing in inflation stimulus. So, run off a Fed's balance sheet. The first step is to stop purchasing new mortgage bonds. They're going to hike the federal funds rate, like we said. They're going to taper first and then hike the funds rate. And they're still reinvesting $70 billion a month. I mean, $70 billion with a B. That's a lot of money. I mean, it's a large force that they're doing. When they stop the reinvestment, and when they start tapering their reinvestments, mortgage rates can move higher than previously thought. All right, stock market forecast. All these are stock market statistics, basically median price to earning, price to gap, price to Schiller earnings, all these different things. You can kind of look these up. But historically, all of these are overvalued. That's what we've been saying for a long time. Stocks are very expensive based on their multiples and their earnings, what have you. So you have to be careful. Like, are we set up for this? Again, if they do start to taper and they do start to raise rates, what's going to happen in the stock market? Rate hikes can cause PE multiple contraction, resulting in lower stock prices as seen in the past. So we're forecasting about 10% decline in major indices. So that's what we're predicting based on the action that the Fed has to take in order to fight inflation. Right, interest rate forecast. So anticipate mortgage rates on the rise. Excuse me. They're going to hit about 3.75. Towards the end of the year. I know, of course, it's all credit dependent. Definitely shop around and get the best rate, and be careful when you look at discount points, because a lot of times they're gonna start saying rates are lower than what they're advertised, but they just cost more. So just really make sure you shop around. So, but also remember, 2018, not too long ago, we were at 5%, guys. 3.75 historically is still amazingly low. Okay. With Fed action, softer stock market, slower economic conditions, we head into a recession based on the Fed action. We might have the second half of the year towards 3%. So we'll be able to touch the high twos again, possibly towards the end of the year. Okay, our forecast, our rates will rise to 3.75 and head down to 3%. Okay, and again, strategically, less upfront fees. Refinance opportunity ahead. Don't buy out your MI. Get the highest, higher rate. And what I always do, I show you side-by-side options so you can see, what's possible. And I always usually recommend the one with the lowest cost, especially today. All right, housing forecast. Of course, every market's different depending on your state or even in your neighborhood within your city or county. So, we believe housing will remain strong in 2022. Demand might slow down, might soften, but be careful when you have all these doomsday predictors about this is going to crash. Basically, it's like you're going 100 miles an hour on the freeway, and now you're only going 80 miles an hour. Okay, it's decelerating. It's not slowing down or going in the other direction. And you guys need to understand, nomenclature and terminology when you see it's like, oh, housing demand's going down. It's like, okay, I know that you've talked to people and demand is still very, very high, still very, very, very robust. So, and with demographics and now that the millennials are the largest generation in the country, they have a huge housing demand. So there's, supply will increase, but remain tight. It's harder to complete homes. I know here in Florida, it seems like every piece of land is being developed and it's still not enough. So you have to keep that in mind. Semiconductor shortages. Because houses need dishwashers and refrigerators and smart stuff. So all that does its factor. And rents are not getting any better either. So the buy versus rent calculations, which I do several times for first-time homebuyers, it still pans out, especially when you factor amortization, which is your forced savings when you're making your mortgage payment. Just make buying that much better. My advice to clients is just keep fighting. We'll be in your corner with you and your real estate agent to help you fight to keep your offer presented to sellers. and you just gotta have to look even harder. You know, that's really all we can do is to keep it on there. Still a great time to buy. You know, our forecast mid to high single digit appreciation, providing a great wealth creation opportunity. So it is worth it in the end. So you're hanging out there making multiple offers, maybe even a little over list. In the end, it's going to be worth it. So this is the video YouTube wants you to watch. Thank you so much for watching. I'll see you on the next one.